Good afternoon. Welcome to Midcap Radar. I'm Sonal Bhutra. With me is Vivek Iyer. As we speak, there's a further fall that we're seeing. The low today was 23,632. We are around that 23,650 mark, which was briefly broken as well. Midcap's a bigger fall, 1,200 points there. And the advanced decline ratio firmly in the favor of declines.
Firmly in the favor of declines, where tightening their grip as far as markets are concerned, and the broader end of the market seeing significant selling pressure, like you just mentioned. But we have quite a lot lined up on the show. Let's start off with the top headline. A sea of red on Dalal Street as all sectoral indices trade lower. Nifty breaks below 23,700 level, while the Midcap index falls over 1,000 points intraday. Both the Nifty as well as the Nifty Small Cap Index are down 10% from their respective record highs.
Food delivery major Swiggy lists at a premium to its offer price of $3.90, delivering gains to IPO investors after a not-so-strong subscription. Analysts, however, remain divided on the potential for gains from investing in the stock.
Acme Solar Holdings made a big stock market debut at a discount of over 13% from the issue price of Rs 289. Management tells CNBC-TV18 that the bulk of capacities that they have signed will come online in the next few years.
Sula Vineyards slips over 5% after reporting a weak set of Q2 earnings. The company says demand environment remains soft and they remain cautiously optimistic for the second half of the year.
KNR Construction's Q2 revenues grows 87% on a year-on-year basis, while EBITDA zooms over 3 times. Stock surges over 14% intraday.
Okay, so below the 23,650 mark on the Nifty right now, it's a 240-point cut that we are seeing on the Nifty. If we talk about the mid-caps, that's the bigger, cut that index is seeing right now. So that index is down around 1,200 points. The Bank Nifty down 1%, and in a market like this, we can actually say that the Bank Nifty is outperforming what the broader markets are doing. The FMCG space not doing so well, but we have big cuts coming in from the metal index, the auto index, which is down around 20% from its peak, and the realty space as well. So it's an all-round fall. We can't really pinpoint a particular sector which is doing well.
Well, you were just speaking about the metal index. Some of the names there are seeing quite a bit of selling pressure. But have a look at the pharma names as well. A lot of them too have seen significant selling pressure, quite a lot of erosion as far as prices are concerned in the pharma pack as well. But this is our special segment, Midcap Movers. Hormaz is standing by the wall to take us through the midcaps that are moving around in the session.
It's difficult to find gainers in a market like this, right? And the levels at which the Nifty is right now, it's exactly a 10% drop from the record highs of 26,277 that it had in September. But starting off with losers then from the broader markets, and there are plenty of them. So in a market like this, you are spoiled for choice when you look at the losers that come up on your screen. Suzlon, the biggest single day drop in nearly 2 years that the stock has seen, a significant correction from its peak. Paytm and HBL Power Systems also down to the lowest point of the day, losses of anywhere between 4 to 6%. Earnings reactions, the final leg of the results season. You just mentioned Sula in the headlines, but then there is Newgen Software, Nykaa, Hyundai as well, now down over 4%. Alchem had a volatile reaction to its results, had briefly slipped into the green, but is now back down over 1% after results that were just reported a few minutes ago. Real estate is a sector that is under pressure. The index is down almost 20% from the record highs, and every constituent of the index and non-index constituents too trading with losses of anywhere between 4.5% to as high as 7% for Aditya Birla Real Estate, down to the lowest point of the day. Volumes and those stocks too, most of them on the downside in today's session, but KNR Constructions still holding on to gains of 7.5%, and Bharti Hexacom, one of the few stocks bucking the trend today on very strong volumes. And lastly, some stocks that are locked in a lower circuit. Akums Drugs is one of them, continues to extend losses after its results. It's a 5% circuit today. Techno Electric in a 10% circuit, and PTC India briefly was down in a 5% circuit, but now down 4.5%. Back to you guys.
Okay, all right. Thank you so much, Hormaz, for joining in as always. Some interesting names there on the list, some mid-cap movers that we are talking about. We'll slip into a short break now. On the other side, we'll be joined by the management of Galaxy Surfactants to discuss their Q2 numbers. Stay tuned for that. Welcome back. You're still tuned into Midcap Radar on CNBC-TV18. Well, Galaxy Surfactant posted a decent revenue growth in its revenues and profits, while its margins declined in the quarter on a YOY basis. To discuss this quarter gone by and the way forward, we are joined by K. Natarajan, the Managing Director, Galaxy Surfactants, joining in now. Mr. Natarajan, good afternoon. Thank you so much for joining in today. Well, you know, your EBITDA per ton, it has come in slightly lower than the guided band of 20,500 to 21,500 rupees per ton. You have spoken about some headwinds that the demand scenario is seeing right now. In that case, do you stick to your EBITDA per ton guidance of around 20,500 to 21,500 for the year? Also, what happens to the volume growth guidance of 6 to 8%?
Oh, yeah. Thank you. Thank you for having me on the show. So, yes, I will be sticking to the guidance of EBITDA per metric ton of 20,500, 20,500, because we do see that the way our rest of the world is picking up and the specialty ingredients volumes are going up, we do see that we have a good chance of ending the year within the guided range of 20,500 to 21,500, because we have ended this first half at around close to 20,100. So we do see that things can get improved in the coming quarters. With regard to volume, yes, we do see challenge in India, which was the market that was driving a good portion of our growth. But I think credit to our business model, we've seen the other geographies cooperating well to enable us to deliver our first half volume growth in the upwards of the lower end of the guided range of volume growth. So yes, we will stick to our guided range of volume growth as well.
Okay, so you're sticking to the volume growth guidance of 6 to 8%. You're hoping to reach the lower end of the guided range, and also sticking to the EBITDA per metric ton guidance that you had given of 20,500 to 21,500. Talk to us about the on-ground demand as far as Q3 is concerned. You mentioned that there has been some slowing demand that you witnessed. Also, FMCG companies have spoken about the slowdown. What is the on-ground demand trends as far as S2 is concerned?
Demand trend, I think urban demand obviously has registered degrowth, and the growth in the rural demand has commenced, but not in a significantly superior way to be able to mitigate the degrowth that has happened in urban. The commentary of my customers and our discussion with customers tells us that probably we may have to wait out for 2 more quarters for things to pan out well. The only spoiler in this is the sudden surge in commodity inflation, and that's something that needs to be kept watch on. And our customers also have been looking at how do they increase prices of the end products in a very calibrated manner so that it doesn't impact the very slow pace at which the demand growth is happening.
Okay, so Mr. Natarajan, you speak about the risk that is the higher commodity prices, even your raw material prices, that is fatty alcohol. Prices have risen there, right? Are you able to pass it on to your customers, considering a situation where demand is already on the lower side? Do you think that is something which will be absorbed by the market?
Oh yeah, so this is something that has been significant increase. It's not something that's a very incremental stuff, and it's something that is there for every one of us who is in this market. And that's something that yes, we will pass on. We don't have a choice, and we do see that the customers also accepting it. But the problem is with this sort of increased prices, the sentiment gets impacted negatively, and that's something that we would have done without. We do hope that things get better as we move forward in the coming quarters.
Okay. Give us an update as far as the mild surfactants part of the business is concerned. You've been adding capacity over here. You said it's been gaining traction with MNCs. How much of it is part of the portfolio now, and what are the targets that you've set for yourself over here?
Yeah, special ingredients continue to be about 40% of our overall revenues, and mild surfactants is a significant portion of that. And we do see good amount of projects in pipeline getting matured with many of our customers, and we do see a good traction. And there's a huge focus on this with the way that we are even building the organization for this. We do see this is going to be something that will significantly aid our profitable growth in the coming years.
Okay, so you said specialty portfolio is doing well for you. What is the volume growth that you're anticipating in this segment in the second half, or say maybe FY25, and even in the other segments geography-wise, if you can give us a sense of what will growth look like, which would be the growth driver for the business?
Yeah, so it probably pretty much the template will be similar to what was in H1. You need to have, you will have the rest of the world doing good amount of the heavy lifting in terms of volume growth. We do see that India would continue to be into a flat to 2 to 3% growth, and the balance has to be made up by Africa, Middle East, Turkey, which did have certain supply side challenges in the first half, which is getting taken care in the coming months. And we do see that will aid us in terms of continuing to be in the guided range of volume growth of 6 to 8%.
And you spoke about supply side challenges. We were speaking to Aarti Industries the other day. They said freight costs have come down in last 2 weeks. Is this something which will help going forward? And what about the container delivery or container availability as well? Is that an issue?
The freight rates, geography-wise, there have been some particular corrections, but we need to wait and watch because there's also a high season months as far as the festive season in Europe and America. That will wait and watch, but more concerning is the reliability of container availability and sailing of ships. That's something that needs to improve significantly. And that is what actually ended up messing up our supply chain into Egypt in a significant way. We also had that in India, but we could manage that with little of impact. But Egypt got impacted significantly because incoming got delayed anywhere between 30 to 45 days. Things have improved now, but we only hope that this continues and there is no further escalation in the geopolitical situation, which can then again present with newer headwinds on this front.
Thank you so much, Mr. Natarajan, for joining us and taking us through how business shaped up as far as Q2 was concerned and the way forward for H2. Well, let's now slip into a short break. The management of Epack Durables joins us to discuss their Q2 results on the other side. Stay tuned. Welcome back to Midcap Radar. Well, that company in focus is Epack Durables. The company's expenses rise offset the revenue growth of the company declined as well. To discuss the quarter gone by and the way forward, we are now joined by Ajay Singhania, the MD and CEO of Epack Durables. Good afternoon, Mr. Singhania. Thank you so much for joining us. As far as H1 is concerned, you've seen very strong revenue growth. How is H2 shaping up, and what are the targets that you have set in terms of guidance that you can give to investors for the revenue, EBITDA margin, as well as bottom line?
So thank you. First of all, good afternoon, everybody. See, H1 performance, as we have seen, has been phenomenal with an aggregate growth of almost close to 85% plus and an EBITDA growth of almost 65% plus. So overall, if we look at H1, it has really given us good amount of confidence that our previous commentary of growth of 50% plus for the entire year is on track, and for H2 we'll continue the journey. We have a very strong book going forward both for Q3 and Q4. So overall, in terms of the entire financial year 24-25, we are looking at 50% plus growth for the entire year. And in terms of the EBITDA margins, we continue our stand that overall EBITDA margins would be at similar level what we had achieved last year. So both are on track, and we see that all the steps and efforts we have done in the previous year have started paying off the results. So the revenue growth is something we had lacked last year, and the efforts done have definitely paid us forward.
Okay, your total expenses have been quite high this time around, Mr. Singhania. What explains that increase, and is it something that would cool off in the coming months?
So definitely, see, one expense increase has been can be attributed to two things. One, we are gearing up going forward for H2, and the recent capacities we have created, especially the South plant in Surrey City. So that's got operational only in January. So obviously, first H1, the utilization has been extremely low to the tune of hardly 10%. Now going forward, as the utilization improves, a lot of the fixed costs starts getting utilized. And on top of it, since we are also launching a new segment of products like washing machines and others, so a lot of costs attributed to those new developments have been built into. And as we start utilizing those capacities, we'll see all that cooling off.
Okay, Mr. Singhania, talk to us about your plans as far as the sales mix or the revenue mix is concerned. We understand that the RAC segment continues to contribute majority of the top line. By the end of FY25 and by the end of FY26, how will we see the sales mix as far as Epack is concerned?
Currently, obviously, AC contributes almost close to 80% plus of our revenue, and the non-AC business is 20%. This year, because of a significant increase in AC, AC growth being the market growing at 40% plus, so that definitely has overshadowed the growth in the other directions what we have done. So probably within even this year, AC will still continue maybe 80% plus of our overall revenue mix. But going forward, we are definitely consciously putting a lot of efforts to diversify our product offerings. So like we started coolers, Now, washing machine is something which will start getting rolled out from next month onwards, and then other small appliances and the component business, the EMS opportunities, what we had made an announcement in the previous month. So all those opportunities will start showing off in the results from FY26 onwards, and we definitely see that despite substantial growth in AC, the overall revenue mix or dependence on AC will start coming down. So in a slightly longer term horizon, we are looking at somewhere between, let's say, 60% on AC and 40% non-AC.
Okay, 60% AC, 40% non-AC. You had told us that washing machines could be added by September, October. Are you saying it's been delayed now?
No, so we are on track. We said October the pilot production. We already did the pilot production in October, and end of November is what was targeted as the mass production. So we are on track.
Okay, and what about the other products? Anything that will be done in this fiscal itself, since you're saying majority of the benefit will start coming in from FY26?
So other products like on small appliances side, especially the air fryers are now ready, and Q4 we will see air fryers getting productionized. So that's something on the new product side. Cooler business ramping up very fast. So cooler is something like probably we are the doubling this year and then again doubling next year. So cooler is seeing a lot of traction for us. And then even the product range for our washing machine, which we're starting off with the fully automatic only, then going forward semi-automatic and other SKUs are getting added on. So a lot of new developments in pipeline, which we'll see giving us results in FY26.
Okay, we also want to understand about the strategic cooperation agreement that you have with Hisense. What is the revenue potential over there? When does it start trickling down into the top line as well as the bottom line? And also, as far as FY25 is concerned, what is the target that you have in order to go ahead and onboard new customers?
First of all, talking about the Hisense agreement. Now, Hisense is a very strategic joint venture wherein Epack is investing in creating a dedicated facility for Hisense India. And this facility would be established in phase 1 to cater to the requirements of air conditions, and then going forward other appliances like refrigerators and all. Whereas for washing machine, we already have the capability which has been approved by Hisense, so that would be catered from our current facility. So we are contemplating or we are targeting to start production from end of June. July first week is the target date to start production for AC in phase 1. And within 3 years, the idea is to ramp up the production to almost 1.5 million for Hisense. In 5 years, the projected revenue from both air conditions and washing machines is estimated to cross almost $1 billion. So that's 8,000 5 years from these two opportunities. And as we add other appliances like both small domestic appliances and refrigerators, etc., going forward in next 2 to 3 years, that scale and the revenue would further increase.
Okay. All right, Mr. Singhania, thank you so much for joining in and giving us all those details. That's the word coming in from Epack Durables. In the first half, they've almost done the revenues for FY24, but the gross margins, they were under pressure this time around. The stock is seeing some profit booking. It's already up 100% this year. It was a strong listing that this company or the stock saw as well. Well, for the markets, there's a wee bit of recovery that we're seeing from the lows. The Nifty is above the 23,700 mark. The mid-caps have also recovered, but we'll have to see whether that continues or not, or we'll see further selling from these levels. But for now, we'll take your leave on this edition of Midcap Radar. Stay tuned, your stocks when we return.